Hey friends, today we're diving into a major market sell-off that's sending shockwaves across global markets. Most investors are panicking about the recent plunge in US stocks and wondering if this is the beginning of a larger crash. But I've got a different take. This uncertainty actually creates opportunities if you know where to look. I've been analyzing market corrections for years, and I'll break down exactly what's happening and where the smart money is moving. Today, I'll walk you through the causes of this sell-off, which markets are most affected, and what this means for your investments going forward. Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 768,000 reads and 53,000 likes. I've produced over 700 videos with more than 300,000 watch hours as of December 2024. I also focus on regional and world economy topics. Let's start with what's actually happening in the markets right now. The tech-heavy Nasdaq just experienced its biggest one-day loss since 2022, plunging 4% to 17,468.32. The S&P 500 dropped 2.7%, closing at 5,614.56, and the Dow Jones fell 2.1% to 41,911.71. European markets also sank to their lowest point in a month. This isn't just a one-day fluke. These declines are part of a larger trend we've been seeing for weeks. The S&P 500 is now down more than 8% from its February 19th high, and the Nasdaq has fallen more than 10% from its December peak, officially putting it in correction territory. Think of this like the market catching a fever. It's showing symptoms that something isn't quite right in the economic body. But is this a minor cold or the beginning of something more serious? That's what we need to figure out. Asian markets haven't been spared either. Japan's Nikkei tumbled more than 2% in early trading before recovering slightly to close 0.6% lower. Australia's ASX 200 ended down 0.9%. South Korea's Kospi dropped 1.3%, and Taiwan's TAIEX fell 1.7%. Singapore shares were hit particularly hard, tumbling by as much as 2% before closing 1.9% lower. Have you noticed how interconnected global markets have become? When America sneezes, the whole world catches a cold. This is why understanding global market dynamics is crucial for your investment strategy, even if you only invest locally. Now for the million-dollar question. What's causing this sell-off? The main culprit appears to be growing uncertainty around tariffs imposed by the Trump administration on America's major trading partners, including China, Canada, and Mexico. President Trump himself has acknowledged that the U.S. economy is facing a period of transition, carefully avoiding any mention of a possible recession this year. It's like saying your car is going through a period of adjustment when the check engine light comes on. Technically true, but possibly downplaying the severity. The tariffs are creating a ripple effect throughout the global economy. When countries impose tariffs on each other, it's essentially a tax on imported goods. This makes those goods more expensive, which can lead to inflation, reduced consumer spending, and ultimately slower economic growth. Imagine you're playing a game of economic Jenga. Each tariff is like removing a block from the tower. One or two might not cause the whole thing to collapse, but as more blocks are removed, the structure becomes increasingly unstable. Right now, investors are worried about how many more blocks might be pulled out before something gives way. Have you ever noticed how markets hate uncertainty more than bad news? When investors don't know what's coming next, they tend to sell first and ask questions later. That's exactly what we're seeing play out right now. If you're feeling anxious about your investments, remember that market volatility is normal and expected. The key is to have a strategy that accounts for these inevitable downturns. Here's where things get really interesting. Tim Murray, a capital markets specialist at T. Rowe Price, points out that there's growing skepticism toward U.S. stocks given the country's earnings outlook. Meanwhile, the environment for non-U.S. stocks, particularly in Europe, is becoming incrementally more positive. Murray notes that U.S. stocks typically have featured higher valuations, but also stronger earnings fundamentals than non-U.S. stocks since the 2008-2009 global financial crisis. While U.S. relative valuations remain high, future earnings may not support that premium. The bottom line, With U.S. stocks facing skepticism over the near term, there may be more attractive opportunities elsewhere, particularly in regions offering more attractive valuations, combined with an improving macro outlook. This is like noticing that while everyone has been shopping at the expensive designer store, U.S. markets, there are actually some great deals at other shops, international markets, that people have been overlooking. Smart investors are starting to take notice and shift some of their spending accordingly. But wait, before you rush to sell all your U.S. stocks, let's look at the longer-term perspective. BlackRock analysts, while acknowledging that heightened policy uncertainty could fuel market volatility in the near term, remain overweight on U.S. stocks. They believe a recession is unlikely even though job creation has slowed. They point out that U.S. payrolls data showing slower but still solid job gains suggests market concerns about a recession are overdone. It's like seeing dark clouds gathering, but noticing that the barometric pressure doesn't indicate a major storm is imminent. What do you think? Are you more concerned about short-term volatility or focused on long-term growth potential? This is a question every investor needs to answer based on their own time horizon and risk tolerance. Let's shift our focus to Asia, which is particularly relevant for many of us watching. Michael Wan, senior currency analyst at MUFG, highlights that the region is set to experience a slowdown of investments, but the degree will depend on the magnitude and severity of Trump's tariffs. Wan emphasizes that our North Star is that Trump 2.0's tariffs will be larger and more pervasive beyond the day-to-day whiplash. Now, this isn't just a temporary blip. It could represent a fundamental shift in global trade dynamics. For Asia specifically, while tariff and trade policy uncertainty has already had an impact on U.S. growth indicators, this will over time also feed through to our region through slowing investments into manufacturing factories and also weaker exports as U.S. consumers adjust to a potential new reality of higher prices and lower supply. Think of it like this. If a restaurant, the U.S., suddenly starts charging more for its meals, customers will eat there less often. This means the farmers and suppliers, Asian economies, who provide ingredients to that restaurant will sell less product, affecting their bottom line as well. Wan sees Asian currency weakness in the near term, citing how markets have been underpricing the downside risks of Trump's tariffs and policy to Asia's growth. This currency weakness could create both challenges and opportunities for investors in the region. Have you considered how currency fluctuations affect your investments? A weaker local currency can actually boost returns for export-oriented companies while hurting those that rely heavily on imports. This is why understanding the business models of the companies you invest in is so crucial during times of economic uncertainty. Singapore's market reaction offers a microcosm of what's happening across Asia. Banks suffered heavy losses, with DBS declining 3.5%, UOB falling 3.4%, and OCBC dropping 2.1%. Other major shares like Singtel, SIA, Ciatrium, and SGX also declined more than 1%. ANZ Research summed up the situation well. The sharp sell-off in equities continued as concerns over U.S. tariff policy and government job cuts continued to weigh. No let-up in uncertainty seems likely in the near term given reciprocal and other tariffs will be announced in April, with more to follow in May. This uncertainty is like a fog that makes it difficult for investors to see the road ahead clearly. When visibility is poor, most drivers slow down, and that's what we're seeing in the markets right now. But here's the thing about market sell-offs. They often create opportunities for long-term investors. When quality stocks get caught in the downdraft of a broader market decline, they can sometimes be purchased at attractive valuations. The key is distinguishing between companies that are facing temporary headwinds versus those with fundamental problems. It's like the difference between a healthy tree that's lost some leaves in a storm versus one that's rotting from the inside. During market corrections, I always ask myself, has the long-term business outlook for this company actually changed, or is the stock just down because of market-wide fear? If it's the latter, it might be a buying opportunity. Are you prepared for continued market volatility? Having a watch list of quality companies you'd like to own at lower prices can help you make rational decisions when others are panicking. Remember, the best time to prepare for a storm is before it arrives, not during the downpour. So where do we go from here? The immediate outlook suggests continued uncertainty and potential volatility. The tariff situation isn't going away anytime soon, with more announcements expected in April and May. This could keep markets on edge as investors try to gauge the economic impact. However, it's important to remember that markets have weathered similar storms before. Trade tensions aren't new, and while they can cause short-term disruption, economies and markets have shown remarkable resilience over time. BlackRock's view that a recession is unlikely provides some comfort. They point to the contrast between the strong labor market and soft survey data showing declining consumer confidence. This disconnect suggests that while sentiment may be negative, the underlying economic fundamentals remain relatively solid. Think of it like the difference between how you feel when you have a cold versus your actual physical condition. You might feel terrible, but your body is still functioning at near normal capacity. Similarly, economic sentiment can sometimes be more negative than actual economic conditions warrant. For investors, the key takeaway is to avoid making emotional decisions based on short-term market movements. Having a diversified portfolio that includes exposure to different regions and asset classes can help cushion the impact of volatility in any single market. Remember that famous Warren Buffett quote, "Be fearful when others are greedy, and greedy when others are fearful." Current market conditions might be creating opportunities for those with the courage to look beyond the immediate uncertainty. To wrap things up, let's recap what we've covered today. Global markets are experiencing significant volatility due to uncertainty around tariffs and their potential impact on economic growth. U.S. markets have seen sharp declines, with the Nasdaq entering correction territory, and Asian markets have also been affected. Analysts suggest that uncertainty could weigh on U.S. shares in the near term, while potentially creating more attractive opportunities in other regions, particularly Europe. Asia faces challenges from potential investment slowdowns and weaker exports, but the severity will depend on how the tariff situation evolves. The good news is that despite these concerns, a recession is still considered unlikely by many analysts, suggesting that the current market correction may be more about sentiment than fundamental economic problems. What does all this mean for you as an investor? Stay vigilant, but don't panic. Market corrections are normal and can create opportunities for those with a long-term perspective. Diversification remains your best defense against volatility, and having some cash on hand allows you to take advantage of lower prices for quality assets. I'd love to hear your thoughts on the current market situation. Are you making any changes to your investment strategy? Do you see opportunities in specific sectors or regions? Drop your comments below. Thanks for watching, and I'll see you in the next video.